You are listening to a special preview of the KE Report Weekend Show with your hosts, Corey Fleck and Al Corlin. This preview is brought to you by our friends at goldeagle.com. To listen to the full 2-hour weekend show, please visit www.kereport.com on Saturday morning.
Welcome in. You're listening to the weekend edition of the KE Report. We're devoting segments 1 and 2 to a good friend of ours, a gentleman who garners an awful lot of our respect, and obviously based on the comments we get on the show, a lot of respect from our listeners, Rick Rule. Rick, very interesting time in the markets right now in the sense that on Wednesday, we had the Federal Reserve. Gold proceeded to go down on both Wednesday and then again on Thursday. Is this the beginning of the end for the resource sector?
I don't think so at all, Al. I have two comments on that. One, both you and I have been around long enough to know that bull markets don't go straight up. They back and fill. And I think you're seeing backing and filling. I think the majority of American investors don't know how to spell gold. You will recall on one of our earlier interviews, me citing a study that said that gold and gold-related securities constituted between 1/4 and 1/3 of 1% of investable assets of Americans. The third thing I want to say to that, Al, is that in my own opinion, the most important aspect of the gold price is its relationship, or rather its inverse relationship with the U.S. dollar, in particular represented by the U.S. 10-year Treasury. The U.S. 10-year Treasury has been in a 35-year bull market, with the interest paid falling from 15% to 1.75%. Could the yield fall further and hence the principal value of the Treasury go a little higher? Absolutely. But the truth is that bull market is much closer to the end than to the beginning. And if you believe that they trade in reciprocal fashion, which they've done for 35 years, that means the gold bull market is much closer to the beginning than the end, Al. The Treasury note thing notwithstanding.
Rick, what's your comment on comparing what this bull market looks to be forming in terms of being early on in this bull market compared to what we saw in 2007, 2008, but then also back to 2001 or even before that? What do you think the makeup is now that's either different or similar than those prior bull markets?
I think that those bull markets were sharper because there was more of an institutional and investor memory of the 1970s when gold did well. So in that regard, I think the uptake accorded gold was better in those markets. I think that this market has the possibility, I'm not going to say probability, but the possibility of being much stronger for three reasons. One, physical gold ownership on a global basis is more available now in societies like South Asia, India, China, East Asia, China, that have had a cultural predisposition to gold but haven't had access either because the infrastructure to give them access or the laws didn't permit it. Strike one for now over then. But much more importantly, because gold is much more under-owned in the United States now than it has been over the last 3 decades, and because the bond market is much, much, much closer to the end than the beginning. My suspicion is that this will be the right kind of gold bull market, slowly gathering momentum like it did in the 70s, but from an extraordinarily broad base and with a lot of room to run. If I'm right about the fact that with regards to U.S. Treasury securities, we're at the end of a 35-year bull market and going into a 10-year bear market, the implications for the gold trade are pretty staggering. Remember, of course, I said if I'm right. I believe I am, but time will tell.
The experience that we've had, we have I guess we call it kind of a private fund that Corey and I and 3 or 4 of our radio colleagues have all, put in X amount of dollars, and we're investing based on both fundamentals and technicals. And so far, we have done very, very well in that particular fund. Interestingly enough, we started out and we kind of continue to focus on some of the senior companies, some of which, fortunately, the ones that we have invested in have really done quite well, and they have not really fallen out of bed necessarily to any great extent when we did see a downtrend in the securities that involve this particular industry. So quality really is showing through right now for us anyway.
I think that's a great observation, Al. The senior gold stocks are the ones that benefit the most immediately from the move in the price of gold because they produce enough gold that it shows up on their margin. I mean, they ought to be the ones that respond first. The second thing with regards to this year, I think it's very interesting, particularly with Canadian listed seniors, is that the Canadian generalist institutional investor was way, way underweight gold and materials, despite the fact that materials make up 35% of the relevant indexes in Canada. What that meant is that the generalist investor in Canada has had to aggressively rebalance towards gold because gold was the only sector in the Canadian equity market that was performing. And, most of those institutional indexers were at least closet index investors. And there has been a move by them out of necessity from general market securities in Canada to gold securities because, as I say, they were underweight the only sector that was performing. It's been an interesting scramble after watching them disinvest for 5 years.
Rick, before we get into more of the actual stocks in the precious metals, I do want to get your thoughts on the Fed minutes that were released and the reaction that came after those Fed minutes. Clearly the market discounting any sort of a rate hike, but then the minutes, I guess, changing a lot of people's minds and showing that maybe the Fed is going to raise rates either next month or the month after. What was your overall takeaway from the Fed minutes plus the reaction that we saw?
I have no takeaway from the Fed minutes. I think the Fed's actions now are much more politically driven than they are driven by any particular concern for the currency. And I think that that events will drive the Fed rather than having the Fed drive events. The market looks to the Fed to drive events, of course, but I think the reality is exactly the contrary to that. I think that the market's reaction to interpretations of the intention of the Fed speaks to the point that the equities market that we're in has become very leveraged and also momentum driven. I think the fact that people are making investment decisions based on the stated intentions of what people might do in the future rather than having their decision driven by aggregate debt levels, company-specific debt levels, enterprise value to EBITDA. I think it's interesting to inhabit a world where financial markets are so short-term oriented and so far divorced from reality. I'll tell you, I bet you of all the people in the world who were listening to discussions of Fed minutes, that Warren Buffett, one of the biggest investors in the world, was one of the least interested.
I don't find that to be a ridiculous statement at all. I find that to be a very wise statement. And the reason I say that is I agree with you on the climate, the environment surrounding the investing community right now. And the reason I say that, Rick, when you and I grew up and we started investing back in the 80s, et cetera, or maybe even in my case a little bit earlier than that, it was all about fundamentals. That's really not so much the case today in the conventional markets. Ladies and gentlemen, we've got to take a real quick break for a commercial. Stick around. We're going to be right back with Rick Rule.